Welcome back to Kotak Insights, the podcast where we speak with leaders from India's top AMCs to understand the market outlook and investment trends. In this episode, we're joined by Athol Bhole and Harish Bihani, fund managers at Kotak AMC. Together, we decode this complex economic phase, from growth versus inflation, the rate cycle in India and the US, and global risks, to what's happening with crude, gold, and commodities.
Hi friends, welcome back to another episode in our podcast series. This is the first episode of 2026, and though a little delayed, we actually wanted to shoot this in the first week, but my friends here are too busy. So thank you, my friends. So my dear friend Harish and Athol, both from Kotak AMC, welcome.
Thank you.
So as I said, this is the first episode of 2026, and in some sense, actually it is good that we are delayed because some of the most unprecedented events, at least I have seen in my life, have happened in the last 2 weeks. So what a year 2026 is turning out to be. So we'll talk about that. But before we start, between Harish and Athol, we are looking at close to 1 lakh crore of assets under management, right? Is that correct?
Yeah.
So Athol manages one of our flagship schemes, which is Emerging Equity Fund, and Harish manages another flagship scheme, which is Kotak Small Cap Fund and Kotak Business Cycle Fund. So welcome again. So Harish, let me start with you. Okay, who would have thought the kind of unprecedented geopolitical events which are happening in the world right now, at least not to my living memory. Do you think markets have an ability to even digest what is happening? Because no one knows nothing about anything, right? That's the way at least I think about it. So even if one gets to know कि ऐसा कुछ होने वाला है future में, but markets, do they even have the ability to digest or fathom that what's happening?
Right. So as you rightly pointed out that the ability to forecast for market is almost not there for an event like now. So the unknown unknowns is what we call.
Yeah.
We try and look at our portfolios and make it more resilient so as to ensure that we can capture some of these unknown events. Nonetheless, when you look at specific events which happened over the past few weeks and markets' ability to think through and take a perfect call on this, what we do as portfolio managers is that we think through in terms of where we are and how our thing going to look like, and our ability to be able to navigate this from a portfolio and individual stock perspective is something we think through very, very deeply. For example, the events that happen in Venezuela, how is it that it is going to impact our portfolio not in the near term but also in the medium to long term, and whether our portfolio will be resilient to the impacts that will come through with the changes that's happening. And there's this concept known as strong opinion loosely held. So we have strong opinions on many things at the beginning of the year, but it's all loosely held simply because of events like what happened in the past few weeks that makes us change some of our views and make our views much more updated.
Okay. And Harish, since I know that you've covered power sector very extensively, maybe not so much oil and gas, but power sector definitely yes. So, many of these events, whether it is happening in Venezuela or what is happening right now in Middle East, we are shooting this on 13th of January, unprecedented events, right? Somewhere or the other, they have a strong linkage to what will happen in the oil market. Oil, as we know, that it's a very, very large component of our import bill, isn't it? Anything happens to oil can disturb our external balances, you call it current account maths and the sort. Forget the energy security part of it because that is a big geopolitical issue. How do you kind of process this in your calculations, that what is going to happen in oil market and how will it impact the companies that you are holding in your portfolio?
Sure. Again, when we look at the events that has happened over the past 2 weeks, ballpark based on whatever understanding that we have is that US directly or indirectly controls 40% of the global oil supply today, with US oil supply, Canada, some part of Venezuela, which is obviously there, and Latin America. So they control indirectly or directly 40% of the global supply. What is it that the US would ideally want oil prices to be? Is the second question that we ask ourselves. And these is all are in the realms of probabilities and not possibilities. So we are thinking about probabilities that, okay, this is what US will ideally want in terms of oil price. And the understanding that we have is that ideally they would want lower oil prices because they would want inflation to come down, which will be beneficial for the overall interest rate scenario to come down. So in that particular context, our economy will be far more resilient. Our companies also on average will be far more resilient because most of the raw material in some ways are linked to what's happening to oil, while the overall correlation is broken in the last few, say, months or so, but overall over the medium to long term, it will finally correlate. So in that particular context, oil price coming down is good news for India in general and a lot of companies in India in particular.
Okay. So Athol, although I started with what was happening in the globe for the last 2 weeks or so, because again, as I said, last year hasn't been so great. More or less, large cap indices have been flat. Small mid cap, there has been some correction. Actually, they were in negative territory. So how are you thinking about markets generally for calendar year 2006, 26, and any special favorites you have in terms of any sectors do you think will do better versus others?
You rightly said that in last 1 year we didn't get much of return, and while other markets have actually done very well compared to India. So in this last 1.5 year of time correction or consolidation in Indian market, the valuations which were into euphoric zone in say June or 24 or July 24, they have come down to averages of 20 P. So our trading range is around 16 to 24. Last year we got extended to 24, now they have come down to 20. Also in last 5-6 quarters, the earning growth has plummeted to 5-6% YY growth. Post-COVID, we were growing at 14-15% for 2-3 years, and hence we got very good returns from the market. It went down crashing to 5-6% because of various things like election disturbed the money flow, or the RBI was very stringent during CY24. The monetary conditions were very tight. Probably those two things have impacted the velocity in the economy, and the earning growth came down. But now if you see last 6-8 months, government as well as RBI has taken a lot of steps to stimulate the economy. So cumulatively through this rate cut, GST cut and income tax cuts, and then we are going to get 8 pay commission. I think government is leaving almost 6 to 7 lakh crore on a recurring basis every year with Indian consumers. So either they will save or spend. So I think given the weak base of earnings, given valuations are on the average and earnings are coming back from 5-6% handle to maybe 12-14%, I think the year should be reasonably good for India. But obviously, as you started, the globally things are very volatile. We don't know which way they are going. But on most count, I think Indian economy and Indian markets are pretty looking like at a very good juncture, because what is required for equity markets to do well is basically macro stability and growth and reasonable valuation. I think macro stability we have established on fiscal and current account deficit. Earnings are coming back, valuations are reasonable, and lastly flows are also very important. At least from the domestic side, we have a lot of confidence that the flows which are coming into equity markets should continue. So I think given all this background, I am reasonably positive on Indian market for this coming calendar year. But obviously we have to keep in mind what can come from the external side, which is obviously is not, we can't sort of say about that as of now.
Okay, so Athol, you spoke about flows, and all of us, including me and all our listeners, they are actually contributing to this tremendous growth in Indian financial sector, whether it is through direct stock market, whether it is through investment in mutual funds. But just taking a cue from what you said, that so why is it that they are not seeing this difference and they are not at least stopping to sell, and maybe then they will come back and buy also?
Yeah, I think to a large extent, foreign investors, I think there are 2, 3 things. One by one, I will try to cover. One, I think the narrative we get from a lot of sources is that foreigners are not sort of thinking India is, or they are thinking that India is falling behind on the technology curve, or especially AI, etc. So most of our competitors in terms of market like Taiwan, Korea, China, they have done very well last year. They have something or the other to play that AI or technology theme. While India, we are services players, so we don't have. So that is one, that we don't have investable companies to play AI. Second, foreigners come to India for growth. Last 1 year, our nominal GDP was growing at high single digit. Ideally, we should grow at maybe 12 to 14% nominal GDP handle, which ensures top line growth and profit growth. Last year, our inflation was very low and the growth also came down. So nominal was not growing. So possibly, I think foreign investors, while they are taking that top down view, nominal GDP growth is very important, and that was not or lacking last year, but it is now improving. And obviously relative valuation. So foreigners are obviously capital allocators. They don't buy stocks, I mean they buy countries, so and they allocate capital. So while 1 year back or still we are trading at 20 times P, China, Taiwan, etc., those countries are still trading at 14, 15 kind of P, which is their, so their countries, I mean for example, China's trading range is somewhere between 8 to 14, now they are at 14, but still compared to India they are looking optically cheap, and they have that AI narrative and all those things to support. So I think these 3-4 factors are probably responsible for continuous foreign selling, and on top of that, the I think we are not able to leverage the relationship with particularly US, and the trade deal is not happening. That is also a big overhang on India. As I said, we are doing very well. Despite that, we are doing very well, holding up very well. But had it been there, I think it would have been an added advantage, which is lacking as of now. So I think those are some of the reasons foreigners are not keen on India as of now. But I am sure that if we hold up very well on the fiscal and current and get back the growth, they will have to look at India at some point of time.
And just to add to the last point which Athol mentioned, is that an asset allocator based out of New York or based out of European region, he is looking at the US tariff and he is looking at a significant impact on the Indian economy and Indian markets. While we understand that the first order impact will not be as much, maybe second order there could be some more impact. Nonetheless, it's not a significant impact which will pull down the overall economy significantly. But an asset allocator is also waiting for some kind of visibility or some kind of relief which will come on the tariff side. So that is something that we have been hearing from our friends who are large asset allocators based out of US or European region. And any relief on the tariff front will certainly be a positive. We highly likely see better incremental inflows in the Indian market.
Any favorite sectors, or let's say sectors who are expected to do well in this calendar year?
I think we as a house have come out with a couple of sectors which will do well in the next 1 year. We released that about 2 weeks back. So banking financial services is one where we are seeing tailwinds across many segments in the BFSI space. So consumption another theme. Healthcare is an evergreen theme to us, and healthcare we have many pockets which should ideally do well, especially our domestic facing names, hospital, diagnostic, domestic facing pharma names which are branded generic names. A lot of those companies are very strong, resilient market leaders which will do well not only in the near term but in the long term.
So Atul, yesterday CPI reading came again sub 2%, right? And wholesale inflation, many people say it can be negative territory. Definitely it is not going to be more than 1%. In such a setup, how do you think RBI reacting, especially given that there is global uncertainty? You will want to protect your currency and you will want to protect your reserves at this point in time. So how do you think RBI is going to react?
So I think there is some room for RBI to sort of cut rates, but I think already government and RBI has done, heavy lifting has been already done. Now the economy or the demand has to respond. So my guess is, given this kind of uncertainties which are there, probably RBI possibly can take a pause, observe how the economy is responding to whatever is done till date, and then probably can proceed further. So I think anyway, I think the room to cut rate is maximum left now is 25 or 50 basis points. So probably RBI can adopt a wait and watch approach before sort of continuing with the rate cut kind of scenario, because while as of now we are feeling pretty comfortable on inflation and the readings are coming out to be very benign, and globally it is the case. But I think globally, if you look at, there is a lot of easing going on in terms of fiscal as well as monetary. It has not yet responded, but it can, anytime it can start responding. At the same time, we are starting to see supply side challenges emerging. So you would have heard about anti-involution kind of theme. China is going to start now from April onward. So finally, so China was exporting deflation to the entire world for last 20-30 years. And they have paid a huge price for that in terms of atmosphere or pollution and all those things. Now they are saying that they want to reduce the capacities across industries, reduce the competition and push for sector consolidation. And as late as last week, I think they have reduced some export incentives across battery and many other sectors. So if China adopts that policy with full rigor, I think there will be some inflationary push in the global supply chains. And at the same time, there is so much of easing by governments and central banks.
Yeah.
And we are sitting on very benign base of inflation. So I don't know how the second half of next year will play out. So first half we are comfortable till say March or June. But how it will play out in the second half, it will be very interesting to watch. And I think obviously central bankers will be aware of these things. So I think possibly it can be a wait and watch scenario before they start taking any actions.
So, but I'll just maybe again a question based on what you just said, that as a house, Kotak feels that consumption should do well in this current year, but some of the steps that government or central bank has taken has been there, in play for some time. GST is something which is a little bit more recent. Income tax, it has been 1 year now actually. Last budget we are in January, next month there will be budget. Rate cuts have been happening through the year.
Yeah.
Then why is it that it has not reflected in demand growth as yet?
So I think, so the income tax cuts were announced in February, but they were the implementation started from April. So probably from April onward, people started getting or saving 5,000 if the income bucket is 5 lakh to 15 lakh. GST cut again were implemented from mid-September.
Yeah.
So that is percolating. And the rate cuts, as you have said, were happening. CRR cut also got implemented from September onwards. So now we are seeing home loans from some banks at 715 and 720. Probably 8 months back or 10 months back, they were still at 8% or so. So I think it is the full impact we will see in FY27 of all these measures, and hopefully during that year we will see economy or demand responding. Obviously, there is slack in the rural areas. The agricultural prices have not actually gone up, and hence farm income would not have gone up. So there is a K-shaped recovery in India, which is obviously not good, but it is K-shaped. But we are hoping that once all these things hit the ground, they will percolate to lower sections and the overall demand should come back.
And just to add to what Athol mentioned is that the top 20-25% of India, which has done relatively better in the last few years, especially post-COVID, while we may spend, but we are in no hurry to spend. Even GST cut is a recurring phenomenon. It's not a one-time phenomenon.
Yeah.
So in that case, I'm not in a hurry to buy my next car or the next two-wheeler.
As simple as my life insurance premium has become cheaper, but that I'll save each year now.
Absolutely. So in that case, people are calibrating, looking at the benefit which is percolating to them from all these cuts that have happened, and we'll slowly and steadily see the benefit. So we are not looking at a one-time significant benefit in a particular year, but a recurring benefit which should flow through over many years to come.
Okay.
The other thing which sort of stopped us getting full benefit of this thing is seasonality. So while we have seen auto sector has done well, two-wheeler, four-wheelers, etc., but lot of seasonal products like air conditioners or refrigerators or in general construction activity was weak because monsoon started very early this year from May and continued till October, November in many places. So generally during monsoon phase, the real estate activity, the repainting and all those things actually slow down. But what we hear right now from the channel checks is the cement demand is in double digit. I mean high double digits. So probably it is coming back in a pent up fashion. There is catch up happening.
Yeah.
So I think seasonality played a big role in terms of demand behavior in last 1 year.
Okay. So Harish, so silver has given more than 150% return. Gold is behind, but just slightly behind.
Yeah.
And phenomenal performance. What do people do now?
Sure. So while both Athol and I, we are in general, we're not experts on anything, but in particular not on precious metals. But this is my personal view that, the world changed after Russia invaded Ukraine. And once Russia invaded Ukraine, the then President Biden decided to seize all the assets, US dollar assets of the oligarchs all over the world. And why do somebody buy a US dollar is simply that I trust the country and I trust that my US dollar assets are safe and I can use it whenever I would want to.
Yeah.
That particular thing changed significantly. So whatever has happened with precious metal over the past few years is a clear reflection of the distrust that has increased in the society, especially post Russia invaded Ukraine. And Trump clearly over the past 1 year has not helped the cause. Whatever he has done over the past 1 year or so has actually increased the inhibition that people had in their mind that what will happen to our US dollar assets. So everyone is jittery. And where do we diversify? We can diversify in something as simple as gold, finally, or other precious metals, or to something like a Bitcoin. And that is what is happening. So the personal view is this, that as long as there are more wars globally, and as long as Trump continues to behave the way he is behaving, I guess the precious metals should continue to do well. Because finally, we should all remember that there is something known as a PE ratio for every company. Yeah. But what is the PE ratio for gold?
There's no earnings, so
there's no earnings. And so while it has gone up sharply, and but how can we say it's expensive or cheap?
Because there's no measure to value it.
Right.
There's no cash flow that you can discount.
Central bankers, central governments the world over, and many billionaires and many other people who keep buying gold every year now. So this is again, I want to qualify that this is a personal view and not the house view.
Yeah. Okay. No, in any case, I think what we have been kind of suggesting to our investors is, if you have a strong view on precious metals, please do go ahead and invest. But if you want to be in safer hands with great fund managers like yourself, I think multi-asset allocation is a great way to play out in a more formal setup, where you get an exposure to equity, debt, precious metals, everything is there packaged well, dynamically managed. So I think that is something we have in general been suggesting our investors, that if you have a view, because as you rightly said, something which doesn't have earnings, how do you predict prices of that particular asset? But multi-asset allocation funds are a great way to play. So great. So Athol, briefly offline we were chatting that between the two of you, who will take the technology question, and then Harish has nominated you, so you have to take the technology questions now. AI, okay, and Ruchir Sharma wrote a very nice article some time back that US markets is now a one-way bet on AI. Okay? Whatever happens to AI will determine the fate of US markets. So all the money is pouring into AI or related sectors, whether it is chips, Nvidia has market cap more than India's market cap, whether it is data centers, anything around the AI ecosystem has just zoomed. And how, right? We were talking Taiwan, that also is a chip beneficiary. And the kind of capital which has got committed, obviously, again, I am no AI expert, but the returns now which has to come out of that capital are also humongous.
Yes.
These AI companies very soon, and not so far in the future, maybe in just next 4 to 5 years, have to make trillions of dollars of revenue and then some billions of dollars of profit to justify the kind of investments which are happening there. Is the global economy in general, but US economy in particular, overcommitted now?
So looks like that whenever you do reading or googling on this subject, I think the feel or sense we get is basically there is overcommitment of capital expenditure. All these AI related companies are doing in data centers. So for example, in last 2-3 years, every year they spent like $400 to $500 billion on that infrastructure, and next year they have committed or committing some $650 billion. So the investments are ever growing. Cumulatively they will invest some $2-3 trillion in this 5-6 years bucket, and as you rightly said, the revenue and the profit to justify this investment is going to be humongous, and we have to see how that monetization happens, and that's where the real question is. I think the AI which we are using at the retail level, the chat GPTs and Geminis and all, I think at the enterprise level the use of AI will be very different, and when enterprises start using AI, they will like to see ROI in some tangible fashion, or productivity improvement in some tangible fashion. If that doesn't come, and which looks difficult how it will come, at least at this stage of time, I think the revenue potential or monetization of AI will be under question, and that can cause lot of problem. And one thing is justifying the capital commitments. The other bigger thing is justifying the investor expectations which are built into these market caps or or the stock prices. So even if they can justify the capital commitment by achieving say 8-10% IRR, etc., but what market is expecting continuous growth of 20-30% for next 4 years or 5 years at least. If we get questions that growth rate of 20-30% is actually can be only 10-15%, then obviously this market cap cannot sustain, even though optically the PE ratios are not very high. So people are comparing PE ratios of today and PE ratio during dot-com bubble. So optically they are looking very reasonable. But I think these stocks, all tech stocks globally, have been very, very sensitive to growth rates. 2-3% here and there in terms of growth rate, or even quarterly growth rate, we see basis point difference in the delivery versus expectation. The stock reaction can be very sharp. And it's a very overcrowded market, very well owned market. Globally, people have invested some $18-20 trillion into US from outside US, and US is already investing. So I think there is some kind of bubble building up. We can't say when this kind of bubbles can sort of come crashing down. Timing is the only probably a thing we have to watch. But definitely I think there is a lot of euphoria which is building up in that market, in that segment.
And I would like to add to what Athol mentioned is that when you look at the investment that has gone in, set aside some of the unlisted companies, most of them are already listed companies. And it is not only a question of growth, while it is important, but it is a question of survival in some cases.
Yeah.
A Google of today, or say a 3 years back, is very different from Google of today, and will be a very different Google 5 years out. So in that case, it's better that I invest, because if I don't invest, I might not survive in the next 5 years. And
kind of an arms race, is it?
It's an arms race, and you need to keep investing so as to ensure that you can survive over the longer term. And it might be ROE dilutive in the next few years, which even the Googles and Apples of the world understand, but it might help them survive and thrive over the longer term. So while the investor dissonance or the slowdown which can happen in the near term because they have overspent and they can slow down, and investors' expectation is high and that can come down, which can have an impact on the near term outlook on the economy and market. But from a longer term perspective, what they're doing sounds rational.
So one more thing I just want to point out is, so these are about the expectations and making making ROIs to the expectation on the investment, but in certain pockets the actual risk is building up. So you would have seen that some of these companies are financing this Capex through off-balance sheet items. And in some companies the credit default swaps are actually
expanding.
Is expanding, and they have expanded a lot particularly in last 3 months.
So I read this very nice article somewhere that AI is not a bubble, valuations are. Okay, and let's say even if you look at 2000.com, although I was in college, but reading history, that internet was not a bubble.
Yeah.
Valuations
Correct.
of the
Which is
companies
what,
in
like,
internet was a
mismatch
bubble.
between expectations
Yes,
that we
and
have.
internet,
Yeah.
as we can see, it has changed our lives, and how maybe AI will also do. But let's say it is a bubble, and let's say there is correction. Maybe Harish, if you want to take this, then what happens? Because at the beginning of the conversation, we just discussed that actually India is looked as an anti-AI play. We are not getting any AI flows because we do not have AI companies, right? Maybe when implementation of AI stuff will happen, our IT services companies will pick it up. They will do well, hopefully. But let's say there is a correction, and it will be a big correction if it happens. Then what happens to global markets, and then in turn to Indian markets?
Sure. So as I had mentioned earlier, that when you look at the overall investments that these companies are doing, it is necessary for their survival, for their long-term growth. And in the interim, maybe the investor expectations are running high, and the investments could slow down, our growth rate could come off, and optically things would look worse. But from a longer term outlook, as it happened in the dot-com bubble, that companies which survived during that bubble phase thrived at later stages, including the likes of Amazon or many other companies. And that is what is highly likely going to happen in this particular cycle too. Everybody understands the risk of overspending, but they will have to spend because of the necessity, that while on an individual basis every decision is looking rational, in aggregate it's not looking rational to all of us, especially with companies which are unlisted, which is borrowing money, or there are some scheme which is taking money from one particular pocket and putting it in the other. Those are companies which are at greater risk to our mind. And in that particular context, if the overall Capex spending comes off, will US slow down? How will that have an impact on the overall spending of the US economy? How will that have an impact on Indian IT companies? Is something that we keep thinking about. All those are probabilistic in nature, where we have multiple scenarios in mind on if this is going to happen, then this is how we are going to behave, and that is how we are approaching the entire subject. The entire narrative that India is an anti-AI trade, while it sounds good, but in general, we will do well or we will not do well depending on what kind of companies that we have. So we do not have any companies which are directly linked to what's happening on the AI side. So if US economy itself comes off and US market comes off, then even our markets on average comes off in that particular year, despite being anti-AI trade, etc., whatever we would want to call it.
Okay, so we'll take one last question, and then maybe we'll wrap up. Is this entire IPO frenzy is maybe a strong word, but let's say this strong IPO market that we saw in last year, people are saying that it can continue during this year, and valuations of Indian new age companies. It's a very hotly debated topic, and there are very strong views on both sides, because again, not exactly like gold, but again, these are companies where earnings potential over a longer period of time we are yet to discover. We do not know, and hence if the potential is very high, then any valuation is justified. But on traditional metrics, many of these companies, the valuations look kind of on the higher side. So maybe Harish, I'd like you to kind of comment on it, and then I'll come to Athol. Let's say maybe if you can take, how do you think the IPO market will be this year, and then maybe about valuations of new age companies. Athol, you can comment.
I think IPO market, there are tons of companies which are looking for IPO in this particular year too. There are some large companies, including the likes of NSE, if they get approval from the regulators, Geo. So there's a whole host of companies which are looking for an IPO in this particular year. So in all likelihood, in case market is conducive, the overall paper supply will continue to be very high in this particular year, like the last 2 years.
And do you believe in this theory that supply of new paper kind of caps returns, because there is so much new stock to buy? How will you kind of take the returns higher on the overall market side?
So it's practical that if there's too much supply of anything, then on average the demand for existing goods, and if goods are similar in nature, then the demand for certain goods come off, especially goods which are more commodity in nature. So what is happening is, as the paper supply has kept increasing over the past few years, the number of unique companies that have come into the market have increased disproportionately. They are unique companies where, as you rightly pointed out, that in some cases they are richly priced, but longevity of growth, good return on capital, and moats are very deep. So in that case, every fund manager has to take a call that, do I keep some of the companies which have done okay in the past few years, but are more commodity companies which have their own deep cycles in every particular year, or do I change and switch to some of these much more resilient names which have good longer term growth, maybe slightly expensive. So it's a constant battle which is happening in our minds and in our portfolios too as we speak, which is why you've seen this kind of correction. While broader markets, you look at the headline index, you haven't seen significant correction, but broader markets, especially if you go to you look at the small cap space, it's been a massive correction.
You will know better than me.
Yeah, it's a massive correction, and massive to my mind is an understatement, because the economy is doing fine. It's not doing too badly. Typically, when economy is doing poorly, or US markets or US economy is doing poorly, we see this kind of correction, or there's some headwind which is happening which leads to sentiment weakness, but that hasn't happened. But despite that, we have seen the kind of correction in the past 1 year in the small cap space. It's unprecedented given the shape of the economy, and that could continue, because when you look at something new and something which looks unique and something which is more resilient, you'd want to invest in those, and you'd want to partake with some of your commodity names, and that continues and is happening as we speak.
And Athol, your views about valuations.
So I think I will not complain about the valuation. So sellers or merchant bankers are doing their job. So we have to do our job in terms of whether we want to buy it or not buy. These people try to create FOMO while launching the IPOs to get maximum kind of subscription and push up the prices. So I will not paint the picture with one brush. We have to look all these opportunities on a case by case basis. Obviously, whatever they are promising, or in terms of the growth rate, etc., it will not pan out in all cases. But certainly there are few companies, I think they are building good sort of businesses which will play out in long term. As of now, they may not be making profit. They are just grabbing the land kind of scenario is there. But certainly they are building moats in terms of distribution and scale, and it will pan out over next 5-10 years. So I think we have to look at case to case basis, and in at least in certain pockets, and we are sort of one of the largest investors in quick commerce and food delivery space. So in some cases, I think it is making sense, but obviously we have to make the difference between apples and oranges. So I think it's up to the buyers to decide what valuation they are buying.
Only time will tell which was the apple and which was the orange.
And in a lot of cases, what's happening is that while market understand and appreciate that these are good businesses, strong businesses, we are trying to navigate the short term versus long term. And short term could be weak, 1 quarter could be weak, stocks corrects, then it comes back when things improve. So it's a constant battle between short term and long term for a lot of the quality companies that have IPO'd in the past few years.
Oh, and also, Harish, at least from what I understand, that when things are not doing that great, you can accumulate stock in the size that you want. When the company is doing well, anyway the stock will be running up so much that you end up chasing, and you will not get the desired allocation in your portfolios. Then anyway, it's not going to help the investors. So I agree with you. Only time will tell. And it is so fascinating. The kind of companies which are getting listed. You spoke about food delivery or quick commerce. There are 2 large players already listed. There's a third one on the anvil. This is on back of mega behemoths like, let's say, Reliance Retail, or very large setup like DMart, Reliance Retail, already part of a listed company. Maybe it will get listed separately. So the way this entire landscape is evolving, it is so fascinating to see, both as kind of participants in the market, and also maybe a student of the market, that which company will survive and why one will prevail over the other. So, and we have all kinds of options available. Who would have thought that an education company, originally started as a YouTube channel, will list with such fanfare and actually helping so many students.
Right.
navigate their lives. So this is fascinating. I think personally for me, 2025 was a year of learning in the sense that if you build well, capital is available. I think 2021 was you build, you will get capital. So, but market is a little more discerning now. Only deserving players get capital. So I think thanks a lot. I think we've taken so much of your time. Let's hope that some of the geopolitical upheaval settles down, and all of us, all our investors, they have a happy 2026. 2025 hasn't been that great, especially for you, Harish, since you manage small cap. So it hasn't been that great, but hopefully it comes back. And on that note, thank you again.
Thank you so much.
Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.